Challenges and opportunities of integrating blockchain in finance. Blockchain technology has emerged as one of the most disruptive innovations of the 21st century, gaining significant traction across various industries, particularly in finance. Blockchain's promise of decentralization, transparency, security, and efficiency has made it a key player in transforming financial systems. From reducing fraud and operational inefficiencies to enabling new financial products like cryptocurrencies and decentralized finance, DeFi, the potential applications of blockchain in the financial sector are vast. However, despite its promise, integrating blockchain into the financial services industry comes with its own set of challenges. The implementation of blockchain faces regulatory hurdles, scalability concerns, technological complexities, and the need for industry-wide collaboration. This video explores the challenges and opportunities associated with integrating blockchain in finance, emphasizing the transformative impact it could have on the sector. The promise of blockchain in finance. Blockchain is a decentralized digital ledger that records transactions across a network of computers in such a way that they are immutable and transparent. The technology was first introduced with Bitcoin in 2008, but its potential goes far beyond cryptocurrencies. In finance, blockchain offers the possibility of reducing the reliance on intermediaries, streamlining processes, and enhancing transparency and security. For example, blockchain can enable peer-to-peer transactions without the need for traditional banks or financial institutions as intermediaries. This could dramatically reduce transaction fees, increase the speed of transactions, and eliminate many of the inefficiencies that plague traditional financial systems. One of the most promising applications of blockchain in finance is its ability to enhance transparency. Blockchain records every transaction in a way that is publicly visible to all participants in the network. This can greatly reduce fraud and the risk of financial crimes such as money laundering and insider trading. The decentralized nature of blockchain ensures that no single party can alter the transaction history, providing a high level of trust in the system. Moreover, blockchain can be used to create smart contracts, self-executing contracts with the terms of the agreement written directly into code, thereby automating complex financial transactions, reducing human error, and ensuring greater compliance with regulations. 1. Regulatory uncertainty and legal frameworks. One of the most significant barriers to the widespread adoption of blockchain in finance is the lack of regulatory clarity. Governments and regulators around the world are still in the process of understanding blockchain and developing frameworks to regulate its use. Financial institutions, such as banks, are typically highly regulated, and integrating blockchain into these systems raises a host of legal and regulatory questions. For instance, how should blockchain-based transactions be treated for tax purposes? What standards should apply to smart contracts? How should data privacy laws be enforced in a decentralized system? The uncertainty surrounding these regulations makes it difficult for financial institutions to implement blockchain-based solutions with confidence. Without clear guidelines, firms may be reluctant to invest in blockchain technologies, fearing that they may inadvertently run afoul of regulators. Additionally, different jurisdictions may have conflicting views on how to regulate blockchain, making it challenging for multinational organizations to implement consistent blockchain solutions across their operations. 2. Scalability and transaction speed. Another major challenge in integrating blockchain into finance is scalability. Blockchain networks, particularly those that use proof-of-work consensus mechanisms, like Bitcoin, are often criticized for their slow transaction speeds and high energy consumption. The process of validating transactions and reaching consensus on the network can take a significant amount of time, which is impractical for real-time financial transactions that require quick execution. In traditional financial systems, transactions can be processed almost instantly, thanks to the use of centralized clearinghouses and intermediaries. In contrast, blockchain networks may require several minutes or even longer to confirm transactions, which makes them less suitable for high-frequency trading or other time-sensitive financial activities. 3. Integration with legacy systems. The finance industry is built on a complex web of legacy systems that have been in place for decades. These systems are often outdated, proprietary, and incompatible with modern blockchain technologies. Integrating blockchain into existing financial systems is a significant challenge, as it requires a complete overhaul of these legacy systems or the development of hybrid solutions that can bridge the gap between traditional systems and blockchain-based solutions. The integration of blockchain into legacy systems is not only a technical challenge but also a logistical one. Financial institutions would need to invest heavily in new infrastructure and retrain their staff to manage and operate blockchain-based systems. This can be a time-consuming and expensive process, and many institutions may be hesitant to undertake such a large-scale transformation without a clear return on investment. 4. Data privacy and security concerns. While blockchain is often hailed for its security features, the issue of data privacy remains a significant concern, particularly in the finance sector. Blockchain's transparency means that every transaction is recorded on the public ledger and is visible to all participants in the network. While this transparency can enhance trust and reduce fraud, it also raises questions about how sensitive financial data, such as personal identification and transaction details, can be protected in the finance industry. Privacy is critical. Financial institutions must comply with strict data privacy laws, such as the General Data Protection Regulation, GDPR, in Europe, which requires that customer data be protected and that individuals have the right to request that their data be erased. The immutable nature of blockchain, however, makes it difficult to delete data once it has been recorded on the ledger. This creates a potential conflict between blockchain's transparency and the need to protect individuals' privacy. To address these concerns, blockchain developers are working on solutions that allow for greater privacy while maintaining the benefits of transparency. For example, zero-knowledge proofs and other cryptographic techniques can enable private transactions on a public blockchain without revealing sensitive information. However, these solutions are still in the experimental phase and need to be tested for scalability and effectiveness. Opportunities in integrating blockchain into finance. Despite the challenges, the integration of blockchain into finance offers significant opportunities. The potential benefits of blockchain in the financial sector are vast, ranging from reducing costs and improving efficiency to creating new financial products and services. Here are some of the key opportunities. 1. Cost reduction and efficiency gains. Blockchain has the potential to significantly reduce costs and improve efficiency in the financial sector. By eliminating intermediaries, such as banks, brokers, and clearinghouses, blockchain can streamline processes and reduce transaction fees. For example, cross-border payments, which typically involve multiple intermediaries and high fees, can be processed more quickly and cheaply using blockchain technology. Blockchain can also automate many of the manual processes that currently dominate the financial industry. Smart contracts, for instance, can automate the execution of financial agreements, such as loan disbursements, insurance claims, and trade settlements. This reduces the need for human intervention, speeds up the process, and lowers the risk of errors. 2. Enhanced transparency and security. One of the most significant benefits of blockchain in finance is its ability to enhance transparency and security. Blockchain provides a transparent, immutable ledger of transactions that is visible to all participants in the network. This makes it much more difficult to manipulate financial records or commit fraud. Financial institutions can use blockchain to ensure that their operations are transparent, auditable, and compliant with regulations. In addition, blockchain's decentralized nature makes it less vulnerable to hacking and cyber attacks. In traditional financial systems, a centralized database or clearinghouse represents a single point of failure. A cyber attack on this centralized infrastructure could have catastrophic consequences. With blockchain, however, the decentralized network makes it much more difficult for attackers to alter the data or disrupt operations.